Okay, welcome back to the crash course. We are back. Let me share the page. Hmm. Okay, dear students, let's start IRR, internal rate of return. And quickly, you need to just respond in the chat box. Everybody knows that and how you people are practicing regarding IRR. Are you people using the shortcut of IRR or just using the normal calculation? Please, you can reply in the chat box because now shortcut is available for calculating IRR, which can be seen in the updated kits. If I'm audible, so please you can respond. So in the chat box, please, are you people using normal way of calculating? Something went wrong, what it is? I don't know. There shouldn't be anything wrong. Yes means what? Are you using the shortcut? This yes is for the shortcut? Or this yes is for a long formula? So it's taking a long time now. Recording is happening. Okay, shortcut. Thank you. I just wanted to this confirm this. That's great. Because shortcut makes the life, well, the shortcut has made a life very easy. Okay, IRR, I'll be a bit quick now. Internal rate of return. Relating to IRR, people should know few things. Number one, that IRR is a cost of capital. IRR, what did I say? I said IRR is a cost of capital which gives NPV of nil, zero. IRR is a cost of capital which gives NPV of nil. So IRR is a cost of capital which gives NPV of nil. Simply, if your cost of capital reaches to IRR, then your project will produce an NPV zero. Okay. Now, relating to IRR, you should know few things. Number one, if somebody asks you what is the decision criteria in IRR, it's a very simple decision criteria in IRR. If project's IRR is more than cost of capital, therefore we accept the project. Now listen and listen carefully. This is normally it happens, normally, not always. If IRR is more than cost of capital, normally we accept the project. I said it normally happens, not always. Why? Let me give you an example. For example, there is an organization which says that we will only be making an investment if project's IRR is, let's say, 25%. Just an example. Now the cost of capital is 10% and you have calculated IRR for the project which is 15%. Even though the IRR 15 is higher than the cost of capital, but still this company will not be making an investment because of their investment strategy. Or you can say because of their investment policy. They have a policy they won't invest unless IRR is 25. Which means that if an organization is having a target return in their mind, then obviously then saying this IRR is more than cost of capital, they will make investment, not necessary. That is why I said normally it happens when IRR is more than cost of capital, company is going to make an investment. But if they had XYZ target in their mind, And whatever, then if the IRR is lower than that particular target, they will not make an investment. Okay. Otherwise, the normal decision criteria is IRR is more than cost of capital, then we should be making an investment. Now, you should know some of the limitations of IRR. Limitations of IRR. Actually, there are two types of cash flows. One is conventional cash flow, another is non-conventional cash flows. What do you mean by conventional cash flows? Conventional. Conventional cash flows means, for example, let's say you have an outflow and then you are having series of inflows. That is in conventional cash flow. Another name for the conventional cash flow is standard pattern of cash flows. Standard pattern of future cash flows. So conventional means there will be an outflow and then series of inflows. Even there's a outflow in the last year which represents the tax payment, it is still a conventional cash flow. Sometimes it happens like we did a question, ASA Nelson. So what happened? The life of the project was 5. We went till 6. In the last year, there was an outflow, but that was just a tax payment. So in the last year, if there's a tax payment, it does not create any problem. So cash flows will remain conventional. Now listen, if the project is having conventional cash flows, then you can easily calculate IRR, no issue at all. But if you have non-conventional cash flows, non-conventional cash flows means outflows. Let's say you have inflows and then again outflow, inflow, outflow, outflow, inflow, outflow. If it goes like that, for example, that is a non-conventional cash flow. Now listen and listen carefully. There's one research, there's one study. Only you need to know that study, that's it. Not more than that is in your syllabus. The research says, the study says, if the same project, if the project is having non-conventional cash flows, if the project is having non-conventional cash flows, then for the same project, you will be having multiple IRRs. Repeat. If there are non-conventional cash flows, then for the same project, you will be having multiple IRRs. That is limitation number 1. So in case of non-conventional cash flows, project will have multiple IRRs. So in case of non-conventional cash flows, project will have multiple IRRs. Okay. That is one limitation. Second limitation is extremely important. What is that? Actually, there's one concept. The name of the concept is mutually exclusive projects. Okay. Can anyone tell me what is the meaning of mutually exclusive projects? Be quick. Mutually exclusive projects. Can I say mutually exclusive projects means, listen. Rule of OR. Let's say if there are 2 projects which are mutually exclusive or 3 projects which are mutually exclusive, it means you can opt only one. Repeat, when you have 2 or 3 projects which are mutually exclusive, then you can only opt one out of them. Can I say if there are 2 or 3 mutually exclusive projects, which means rule of OR, I can opt only one. If we can opt only one, then I'm going to opt the project which has the highest NPV, not the highest IRR. Because there is no concept that the project which has the highest NPV will have a highest IRR. There is no such concept at all. So logically, in case of mutually exclusive projects, what is the limitation I'm telling you? You can write in your own words. In case of mutually exclusive projects, instead of using IRR, company should opt the project by using NPV. Because when 2 or let's say 3 or 4 projects are mutually exclusive, I can opt opt only one, then I'm going to opt the project which has the highest NPV. So it means that in case of mutually exclusive projects, IRR should not be used to decide which project should be opted. So I just discussed two limitations with you. One is non-conventional one, another is in mutually exclusive projects, instead of IRR, actually we make the decision on the basis of NPV. There's another limitation as well, which you can write. IRR is a relative measure which results in a percentage. And percentage can be misleading. IRR is a relative percentage, is a relative measure which results in a percentage, and percentage can be misleading, obviously. Okay, on the other hand, if we say something in the favor of IRR, or you can say the advantages of IRR, obviously IRR works on cash flows. Second, IRR considers time value of money. All these things are good, but it has limitations. It has one more limitation. What is that? Let's say, just an example, okay? T0, when the class will end, it will continue, keep continuing. It will end, don't worry. I think I'll try to end the class after, inshallah, 3.5 hours. Okay. Just after 3 point, but there will be one break as well. So, inshallah, that will be Pakistan 10 p.m. or maybe a little bit earlier, inshallah. Okay. Assuming, let's say T0, T1, T2, T3, T4. Let me write the net cash flows. Let's say it is 20, it is 5, it is 10, 15, 12. Now listen and listen carefully. If your examiner says that discount factor is 10%, which is applicable only in T0 and T1, then examiner says at T2, cost of capital becomes 12%. For T2, the cost of capital will be 12%. And let's assume for T3, the cost of capital will be 15%. And for T4, the cost of capital will be 16%. What I want to say, if the cost of capital is changing every year, then seriously, we cannot calculate IRR. Because even I'm calculating an IRR, I just need two percentages, one with the positive NPV, second with the negative NPV. If you come across a scenario where cost of capital is changing every year, then IRR will be having a troubles. Then you will be making an assumption. Let's take the highest cost of capital and the lower cost of capital. But the question is that you are making an assumption. IRR cannot use the cost of capital of each year if it is changing. So that is another limitation of IRR. But when it comes to NPV, NPV has no issue at all. Even the cost of capital is changing every year, NPV does not mind. NPV can be calculated. So you need to know these limitations. One is non-conventional cash. In case of non-conventional cash flows, same project will have multiple IRRs. Second, in case of mutually exclusive projects, instead of making the decision on the basis of IRR, project should be opted on the basis of NPV. And third, if the cost of capital is changing every year, then IRR will be having problems. Then it will be difficult, it will be complicated to calculate IRR. Or IRR cannot deal with this scenario properly. NPV can deal it. I just want to write a formula, even though it is no more needed. A, we know that this is a discount factor cost of capital where NPV is positive. A is also called a lower discount factor. Lower discount factor. Capital A is the positive NPV. At the rate discount factor is small a. Capital B is the negative NPV. At the rate discount factor is small b. And a small b is the discount factor cost of capital where NPV is negative. Or you can say higher discount factor. But now, due to the availability of shortcut, calculating IRR has become extremely easy. All you need is just use the shortcut. Is equal to IRR, take all the cash flows, and that's it. You will have the IRR. We will see that right now. Don't worry at all. Now let's discuss one more technique, that is payback period. Payback period. We have two types of payback. One is simple payback period, another is discounted payback. Okay. Payback period. Basically, payback period gives you the information of only one thing. The name of that one thing is when your initial investment will be recovered. Once your initial investment is recovered, then cash flows after the recovery of initial investment are ignored. So repeat, payback period. Payback period gives you the information of one thing. What is that? When your initial investment will be recovered. Once your initial investment is recovered, then returns after the recovery of initial investment are ignored. Okay. Payback works on cash flows. Payback works on cash flows. The question is, if payback works on cash flows, so what is the big deal? There is a big deal. Let me tell you. Over here, you need to know the difference between accounting profit and cash flow. It is important because in the payback period question, examiner can use it. What is the difference between accounting profit and cash flow? Now, please listen the answer carefully, okay? What is the difference between accounting profit and cash flow? The answer is there are number of differences. There's not only a one difference, there are number of differences. But now, just to keep financial management simple, we consider only one difference. The name of that one difference is accounting depreciation. So there is an objection from the cash flow on the accounting profit. The objection is that while calculating accounting profit, one non-cash item is deducted. The name of that non-cash item is accounting depreciation. I've already mentioned there are many differences in accounting profit and cash flows, but to keep financial management simple, we talk about only accounting depreciation. Otherwise, we know that impairment loss is a non-cash item. If I go towards IAS 37 provisions, non-cash items. But as I mentioned earlier, there are so many unrealized gains, unrealized losses, all are non-cash items. But I really want to say one thing. To keep financial management simple, we talk about only one difference. So what is the benefit of knowing this difference? Look at this. It means cash flow is actually equal to accounting profit plus accounting depreciation. What if you come across a question where examiner is asking you to calculate payback period and he has given you accounting profit? So you have to add accounting depreciation to the accounting profit to calculate cash flows. Okay. Now let's talk about a simple payback period. Let's take an example of simple payback. In simple payback period, actually we ignore time value of money. T0, T1, T2, T3, T4. Let's take the cash flows. 100,000. Let's say we have 40. We have 30,000. 50. 70. Cumulative cash flows. 100,000. Okay, you have invested 1 lakh and you have recovered in T1 40,000. If I have invested 1 lakh and I have recovered 40, so how much is still left? 60,000. In the second year, I recovered 30. So how much is still left? 30. T3, we recovered 50 and we just needed to have 30 to recover our initial investment. It means in T3, you will be having a positive cash flow of 20,000. As soon as you are going to get a positive cash flow, it means you have reached the payback period. As soon as your cash flows, they get positive, it means you have reached the payback period, and after that, whatever the cash flow comes, ignore it. So what is the payback period? It will take 2 years, but not the entire third year. Because in year number 3, we have recovered 50,000. We were required to, we just wanted to have 30 more to recover our initial investment, but we recovered 50. It means 30,000 logically you have recovered before the end of the third year. So what do you have to do? Payback will take 2 years, plus whenever you are having a positive cash flow, it means you have reached the payback period. Now what to do? Take the negative cash flow, which is just preceding the positive one, which is 30,000. Ignore the negative sign. Divided by this 50. If you multiply with 12, then your answer will be 2 years and some months. If you're not multiplying with 12, then your answer will be in number of years. So I'm getting 2 years and 7.2 months, or make it 7 months, no issue at all. Two years and approximately 7 months. Now listen and listen carefully. But you can simply follow the mathematical rounding off. 7.2 means you can make it 7. Otherwise, if you want to be more logical, then logically, payback period is, you can say 2 years and 8 months. Why? Because 7.2 months means you have exceeded 7 months. So month number 8, logically it has started. If you want to be more logical, then logically you have started month number 8. But it's okay. Normally our examiner, what he does, he normally goes for rounding off and according to mathematics. So 7.2 means mathematically you can make it 7, no issue at all. This is simple payback. In simple payback period, what do? We ignore time value of money. Now let's say payback is 2 years and 7.2 months. So you can just go for the mathematical round off. 7.2 means you can take it 7 months, which is perfectly all right. But if you want to be more logical, then you can say logically month number 8 has started, because 7.2 months means what? 7 months ended. Payback working. At T0 you've invested. At T0 you've invested 1 lakh. Okay. And T1 you have recovered 40. If I've invested 1 lakh, I've recovered 40. So it means 40,000 is my inflow. 1 lakh is my outflow. If I do the netting off, I'll get 60 negative. Yes or no? Then in T2 we recovered 30. So this 30 negative 60 is still 30. We are left to recover 30,000. But when we reach at T3, instead of negative, we got a positive cash flow. As soon as you start getting positive cash flows, you stop here because you have reached the payback. Then how do we calculate payback? Obviously, it will take 2 years, but not the entire third year. So take the cash flow, which makes your cash, take the cash inflow, which is making overall cash outflow inflow. This is 50. So I took that 50. Take that last negative cash flow, ignore the negative sign. If you're multiplying this with 12, then your answer will be 2 years and in 7 months. If you are not multiplying with 12, you can do this also. 30,000. From where did I get this 30? I'm talking about this 30 and 50. So I think you are getting 2.6 years. Is this clear now, calculation? I think calculation is pretty simple. Okay. If we go for discounted payback. Okay, before going to discounted payback, let me tell you one more thing. For example, let's say the examiner says the initial investment is 1 lakh. Annual cash flows 40,000. Project life is, let's say, 4 years. The requirement is payback period. Now listen and listen carefully. Number one, nothing is mentioned, and if examiner is asking calculate payback, then it has to be a simple payback. Repeat. If examiner is asking you to calculate payback period, nothing is mentioned, it will always be a simple payback period. Okay. Other thing, if you have been given annuity cash flow, look at this annual cash flow is 40,000. If every year you are getting 40, that is an annuity cash flow. Whenever you are calculating simple payback period, given cash flows are annuity cash flows, then you will be using the shortcut. Payback is equal to initial investment divided by annuity cash flow. It means investment is 1 lakh. We are recovering 40,000 every year. So it will take 2.5 years to recover the entire investment. If your initial investment is 1 lakh and you are recovering 40,000 every year, it will take 2.5 years to recover the entire investment. But this is only applicable, number one, the question is of simple payback period, and second, you have been given annuity cash flow. Okay, now let's see the discounted payback. What is this? What is this? Okay. Discounted second teachers. Yeah, we can do it right now, no issue at all. Discounted payback period. In discounted payback, how do we calculate payback? Only you have to just work on present values. Let's see the difference. T0, T1, T2, T3, T4. Cash flows, let's say you have made an investment of 1,50,000. In the first year, you are going to recover 50. Then let's say it's going to be 80. Okay. And then let's say it's going to be 70. And let's say it will be 200,000. Umar, is there any question? Umar Farooq, is there any question you can ask, please? In the chat box, please. Is there any question because you have raised the hand? Okay, what is the question? Please go ahead quickly. What is the question? Okay. Can we not use NPV Excel formula for discounted payback period? Actually, you can only calculate the discounted, no, payback is, shortcut is not available. There's no shortcut for the payback on Excel, which is not available. Look at this discount factor. Let's say discount factor is 10%. 1. So how do we calculate the discount factor of each year? One student was asking also. It's very simple. For the first year, it will be, there's a formula 1 plus R, the power is minus N. So the first year, it will be 0.909. The second year, it will be 0.826. 751 683. All you need is, if you need a discount factor for the second year, so take the power minus 2. You will be having the same results which I've just written. Now we have to calculate the present values by multiplying cash flows with the discount factor. 1,50,000. 50,000 to 0.909. 66,080. Yeah, it will be given to you. It will be given to you. Definitely. 52,570. But discount factor you can use, discount factors can be calculated on the Excel by the help of shortcut, which I'll show you. Because we'll be discussing only those shortcuts which are available in exam. 200,000 into 0.683, I'm getting 1 lakh. 36,600. Now, the last column comes for the cumulative cash flows. One lakh 50. You have recovered how much? 45450. So 1,50,000, which is negative, the positive 45450. How much is still we need to recover? We still need to recover 1,04,550. $38,470. Now look at this. I'm having positive 14,100. As soon as the first positive answer, if you got, it means you have reached the payback. So how do we calculate now? Payback period for this project. Payback period. How much time it will take? It will take more than 2 years, obviously. 2 years plus 38,470. Ignore the negative sign, divided by 52570 into 12 means your answer will be 2 years and months. Let's see. 38,470 divided by 52,570 multiplied by 12. Please, it depends on the cash flows. If your cash flows are after tax, then discount factor will be after tax. And normally the discount factor is after tax. If your cash flows are pre-tax, then discount factor will be pre-tax. Umar, is this clear? So if cash flows are after tax, then discount factor will be after tax. If cash flows are before tax, discount factor will be before tax. If you ask me, then normally cost of capital is after tax. I hope it is. It is clear now, Umar? Umar. Waiting is the point is clear to you? You took very long time to say yes. Okay, 2 years, and you can say 9 months. Okay. Now listen. The good thing about payback is it works on cash flows. It's a good thing. Discounted payback considers time value of money. It is also a good thing. But there are problems or limitations in payback. Number one, returns after the recovery of initial investment are ignored. Another thing is payback cannot measure the potential effect on the wealth of shareholders. There are two projects in front of you. One is having a payback period of 2 years, another is having a payback period of 3 years. If your entity is making the decision just on the basis of payback, so obviously your entity will opt the project which has a lower payback period. But the project which has a lower payback period, I have opted. What will be the impact on the shareholders' wealth? I don't know. Payback doesn't know. There's a possibility the project with a longer payback might be more beneficial than the project with a shorter payback. So simply payback does not measure the potential effect on the wealth of shareholders. Because when I talk about NPV, if NPV is positive, simply you should be opting the project because it will increase the wealth of the shareholders. But when it comes to payback, you have opted a project with a shorter payback, but still you cannot say that what will be the impact on the wealth of shareholders. That is the limitation of payback. We have one more method of investment appraisal, that is ARR, accounting rate of return. Another name is ROC, return on capital employed. Formula is very simple. Just take average annual accounting profit divided by initial investment multiply by 100. Or there is another possible formula also. Average annual accounting profit divided by average investment. How do we calculate average investment? Initial investment plus RV divided by 2. Now listen, if it's a long question, let's say the question you are dealing with ARR, it has come in section C. Nothing is mentioned, it is up to you. You can use any one of them. But normally in MCQs and even in the longer question, normally examiner mentions which formula you need to use. If nothing is mentioned, then you can use any formula. But if ARR question comes in a multiple choice question, then definitely formula will be mentioned. Now I have a question. I need answer from you guys. What is the formula? Average annual accounting profit. Let me change the color. So let's see what is the average annual accounting profit. I have a question. My question is, accounting profit itself is having several definitions. Gross profit is an accounting profit. Operating profit is an accounting profit. Profit before tax is an accounting profit. After tax, profit after tax is an accounting profit. Even the retained profit is also an accounting profit. So my question is, which accounting profit will you be using this in this ARR? Please. I hope everyone has understood my question. There are several definitions of accounting profit. So which profit will be using it? Okay, let's see what is the answer. MashaAllah, MashaAllah, MashaAllah. Total cash flows plus residual value, will it give you Umar profit? Is this equal to the profit? Umar? This is the way to calculate profit. Cash flows plus residual value. Umar, what do you have written, Umar? It's having no head, no tail. Operating profit. One student is saying operating profit. Okay, now listen. Let me make it easy for you. Let me make it easy. Normally, examiner gives you the data, and by using that data, normally you will be able to calculate. Normally, I would say accounting profit before tax. Normally, we use profit before tax. Normally, okay. Okay. Now I'm just giving you the question. Quickly, just answer, okay? But within 4 to 5 minutes, I need the answer. Please don't take more than that. Projects we have two A and B. Initial investment 200,000, 1,50,000. Residual value we don't have. Project life. Let's say 4 years and 4 years. Time T1, T2, T3, T4. Cash flows. Cash flows. Let's say 50,000, 80, 70, and take it 80. We have 50, 50, 60, and 60. Okay. Just a minute. Required is calculate ARR of both the projects. Company uses 25% written down value for depreciation purposes. ARR by using initial investment. So let me zoom out so you can read the whole data. So please, you have 5 minutes. Please, I need the answer quickly. You have 8 to 9 minutes to solve it. Please quickly solve. Then we'll be discussing, inshallah. Okay, let's see what are the results. Students have shared the answers. Okay. Okay, we have discussed one concept. The name of the concept is cash flow is equal to accounting profit plus accounting depreciation, which means that if you need accounting profit, you can get this accounting profit from the cash flows if you deduct accounting depreciation. Okay. Another thing is total depreciation is equal to the depreciable cost. Total depreciation is equal to the depreciable cost, and the depreciable cost is simply the cost minus RV. Cost minus residual value. If there is no residual value, then depreciable cost, total depreciation will be equal to the cost. Now look at this. Let's solve it here to save the time, because I have to take a prayers break. If I add all these 50,000 plus 80 plus 1780, I'm getting 280. And 220. Can I say that is your total cash flows? Now let us deduct the total depreciation. Since there is no residual value, so the total depreciation will be 200,000 and 1,50,000. Here comes your total profit. 80,000. I believe 70. This total profit is the profit of 4 years. So we need average annual accounting profit. So simply divide this by 4. Average annual accounting profit, 20,000. I think 17,500. Yes. So let's calculate ARR. Project A. Annual accounting profit is 20,000. And on the basis of initial investment is 200,000. So I'm getting 10%. Project A. Project B. 17,500 divided by 1,50,000. So 17,500 divided by 1,50,000. 11.67%. So on the basis of ARR, we should go with project B. So students, your answer were quite different. The repeat is different. Omar, how did you get 35 and 40%? And there's one more student who got the same result, I think. No, Hamad got the 43 and 34%. Omar, how did you get this 40 and 35? Omar, can you give any idea, please? You use the wrong formula. Great. Okay, what should I repeat? Let me repeat again. I'll be a bit quick. I have 2 minutes, then I have to take the break. It's a simple formula. Total cash flows divided by minus total depreciation, you will get total profit. Total cash flows minus total depreciation gives you the total profit. Divided by the life, it gives you average annual accounting profit. And it is mentioned in the question that use initial investment to calculate ARR. So calculation is simple. Total cash flows minus total depreciation gives you the total profit, then divided by the life of the project gives you average annual accounting profit. Is this clear to everyone now? Please be quick. And let me listen to my IT person what he was saying. Yes, just uh, Muhammad Ali. What will be the total depreciation? Either you are using reducing balance method or straight line. Tell me. IS 16 property plant and equipment, the total depreciation will be equal to depreciable cost. The depreciable cost is cost minus RV, yes or no? If there is no residual value, then your total depreciation will be equal to total cost. Am I right? I deliberately have written 25% reducing balance method. Okay. So, dear student, I'm just taking a prayer break. I'll be back, inshallah, within, it will take around uh, 22 to 25 minutes. So, I'll stay online. It's up to you. You want to stay online or not? So, after 25 minutes, inshallah, we'll resume the class. Okay, dear students, let me save this page and then I'm going to share the one question with you. Let me just write the message. Let me just share the question with you. So I hope everyone can see this question. The name of the question is Malplash. Came in March, June 2022. And they're asking you to calculate NPV 5 marks, IRR 2 marks, payback period 1 mark, return on capital employed by using average investment 3 marks. Discuss the suitability of the techniques you have used, undertaking whether for determining whether to undertake the investment and advise whether Malplash company's proposed investment is financially acceptable. If NPV comes positive, then obviously it is financially acceptable. I really want every one of you try to attempt this question and then we'll be solving in 1 or 2 minutes together also, inshallah. Let me listen what IT people are saying. Let's solve and solve together. First, we need to calculate NPV of this question. Melplash company, okay. PDF, all the PDF I'll send after the class, don't worry at all. In the group, today's PDF will be shared in the group, inshallah. Just after, right after the class, I'll share, inshallah. Melplash company manufactures motorcycles. Okay, let's solve this one. Then from next onwards, inshallah, I'll be sending the question on WhatsApp. Don't worry. Melplash company manufactures motorcycle and is considering an investment in a new high performance model. The market for high performance motorcycle is very competitive, and Melplash company's directors want to recover the cost of investment in the model quickly before it is made obsolete by more advanced models at the end of 4 years. The directors also wish to show shareholders that the investment will be profitable. The directors have therefore set a target payback period of 2 years and target return on capital employed is 20%. Look at this. They have a target payback period of 2 years. It means if within 2 years, payback is within 2 years, they will be opting it. They do have a target return on capital employed, which is 20%. The directors have also asked the finance director to provide NPV and IRR, okay, calculations for the investment. They plan to consider the results of these calculations if the investment fulfills the targets for payback and return on capital employed. That is very important. What finance director is saying? He's saying also give us the NPV of this project, IRR as well, if the project meets the target of payback and it meets the target of ROC, then give us the calculation of NPV and IRR also. Melplash company has prepared the following forecast of production and sales of the new model. Motorcycles, the volume is 25,000. Then second year, 45, 40 and 20. Malplash Company's finance director has prepared the following information relating to the investment proposal. Initial investment is 220 million. Residual value at the end of 4 years is 30 million. Selling price, year one price term is 20,000 per motorcycle. Inflation is 6%. It means if we need to incorporate inflation, so inflation will come from the second year. Why? Because examiner has given us first year prices. First year prices are given, it means inflation till first year is already incorporated. We are required to incorporate inflation from the second year. Variable cost again in year one price. Inflation is 6%. Incremental fixed cost, additional fixed cost is always irrelevant. Again in year one price. And inflation rate is 10%. So obviously more than one inflation rates are here. So you should be using nominal terms, and they have given you the nominal money discount rate 14%. We need to calculate NPV. Now listen, I'm just ignoring 3 zeros of the sales volume. And what else? Ignore taxation. Okay, the question says ignore tax. It means there will be no calculation of tax saving from capital losses. Okay. Now listen, I'm just ignoring 3 zeros from this motorcycle and 3 zeros from the selling price to keep the calculation simple. How we'll calculate the sale? Let me give you the idea. So then we'll go towards Excel. So in the first year, you'll be taking 25. Can I say multiply by 20? So the sales will be 500 million. The sales volume of the first year is 25,000. So I ignored 3 zeros. I took 25. The selling price for the first year is 20. I'm ignoring 3 zeros. Now, second year, we'll take 45. Multiply by 20 into 1.06. Because inflation will be incorporated from the second year. So what will be the amount of the sale for the second year? 45 into 20 into 1.06. So in second year, you will be getting sales 954 million. Third year, 40 multiply by 20 into 1.06 square. So the sales amount of third year I'm getting 898.88 million. You can simply make it 899 million. Fourth year, you will take 20 into 1.06. The power is 3. 476 million. I hope that everyone has understood the calculation of sales. Is this clear? We'll be solving this on the Excel, inshallah. So you can just tell in the chat box. Is this clear to everyone? Okay, great. We'll be using the same way to calculate variable cost. So like sales volume is, for example, 25 in year one into 14, whatever comes, it will be the sale of first year. For the second year, the volume is 45 into 14 into 1.06. For the third year, we'll take 40 into 14 into 1.06. I hope now you know that in how we'll calculate variable cost in T4. Okay. Incremental fixed cost will incorporate the inflation from second year. Cost of capital is 14%. So I think very easily we can calculate NPV. Let's go to Excel and calculate. Since we have to calculate IRR also, so it's better to go towards Excel, use the shortcut. I think, okay. Malplash, we are calculating part A, solving first part of that, NPV. Project life is, I believe, 4 years. 0, 1, 2. Oh, did I share the page or no? I think I've shared the page. Okay, it is 3 and then 4. Dollars in million. Let's take initial investment. I think initial investment was minus 220. Sales. Let's properly calculate sales. Let me show you the working one. Any question? 500 is. I just want to show the calculation over here. Sales time is 1, 2, 3, and 4. Sales volume by ignoring 3 zeros. In the first year, I think it is 25. Can anyone tell me what is in the second? Second year, I think it is 45. Please correct me if I make any error. 40 and last it is, I think, 20. Am I right? Yes or no? Sales volume. Selling price is 20. Is there any error? No. Okay. Selling price per motorcycle. It is 20 in the first year. After that, it will increase by 6%. 1.06. 1.06. 1.06. Here comes the sales. Okay. 25 multiply by 20. Option of the drag, which works in exam, obviously. And you have to show the links, okay? Like you have to create the link. Because whoever is going to check your calculation, that person is going to just select the cell. Then automatically the address shows each and everything. Now let's calculate variable cost. Should be working too. I think variable cost is 14 every year. Variable cost per motor cycle. It is 14, and inflation it is again 6% if I'm not wrong. 1.06. 1.06. Now we can calculate annual variable cost. I'm taking a negative sign as well because it is a cost. Take the volume into this. Please, one student at least do keep checking as well. So we should not be making any arithmetical errors. These are the variable costs. Let's select this cell. What was the amount of additional fixed cost? Can anyone tell us, please? Let's see the amount. 120, and then inflation was 10%. Okay. Let's take a negative sign, 120. Yes. One point one. One point one. We have taken sales, variable costs, and additional fixed costs. I think everything has come. Yes or no? Just take the residual value. Which is, I believe, 30. Now we can calculate net cash flows. Net. Let us use the sum formula. Actually, in the question, there is no taxation. In the question, it is mentioned there is no taxation. That is where the calculation is straightforward. Cost of capital, they have given us, I think, 14%. Let us calculate present value from T1 till T4. NPV. Take the rate, comma, all the cash flows. Can I say less initial investment? Here comes NPV. So what about other any student? I think everyone is having the same NPV. NPV is 16.79. It's a million. Everything is a million. We have to calculate IRR as well. Now, please look at the shortcut which is available in exam. Requirement 2. Let's calculate IRR. Just take the cash flows. 0, 1, 2, 3, 4, and that's it. Yeah, you will be using the shortcut, don't worry at all. Let's say IRR. Just take all the values. We're getting 18%. Is this clear to everyone? I hope that you people are also using the same shortcut. Is this clear to everyone? Now we need to calculate. What else do we need to calculate? Let's see. Let me share this. We have to calculate payback period. And let me tell you one thing. If nothing is mentioned, it will always be a simple payback. Yeah, you will get the same answer. Yes, you can do that. Yes. You will get the same result. So let's go for payback. Nothing is mentioned, it will always be a simple payback, okay? Let's take the time is going to be 0, 1, 2, 3, and 4. Cash flows, let's simply take the cash flows. These are the undiscounted cash flows, if I'm not wrong. I hope the option of drag should work. Now let's take the cumulative cash flows. Please, we have invested 220 and in year 1 we have recovered 30. So let's see how much is left. 220. We recovered 30. Still 190 is left to be recovered. In T2, we recovered 154.2. Can I say still 35.8 is to be recovered? So take this. Can I say logically before the end of third year payback period, your payback period is 2 years and some time of year 3 as well. And I think we did discuss as soon as you get the positive cash flow, it means that leave other cash flows, ignore other cash flows. As soon as you're getting a positive cash flow, it means you have reached the payback period. Payback period. It will take, can I say it is going to take more than 2 years? Yes or no? So it will take more than 2 years. If you go back to the little bit, just 1 hour, if you go, I think 1 hour ago, we did discuss when you are using payback formula, ignore the negative sign. So instead of writing negative 35.5, I'm just writing 35.8 divided by with this. So I did not use the divided, just a minute. So actually it is coming 2.28 or 2.3 years. So payback is, you can say it is 2.3 years. I think the target which was mentioned in by the finance director, it is not met. They had a target of just 2 years. It is a little bit over and above the 2 years. Now we need to calculate a return on capital employed as well by using average investment. So let's try to calculate ROCE. ROCE. Let's get total cash flows. Well, let me first write the time. Just a minute. 1, 2, 3, and 4. Okay, now listen and listen carefully, okay? Please let me go to the one note, then I'll explain you something so that we can perform that on Excel. Let me do the calculation. Total accounting profit is equal to total cash flows minus total accounting depreciation. But now listen and listen carefully. You have to notice one very important concept. What is that? Actually, we are trying to calculate total accounting profit. We do have the relationship which I have written, but when you are calculating total accounting profit from the cash flows, and let's say those cash flows are having the impact of residual value also. Now listen and listen carefully. Residual value itself does not come into accounting profit. Look at the P&L. Normally what happens in the P&L, either there are going to be gain or loss on the disposal, which comes in P&L. Residual value, which is the sale proceed of property, plant and equipment, it does not come to the P&L. So if your cash flows are having the effect of residual value, so first you need to eliminate that effect also. If they are having the impact of residual value, if total cash flows are having the impact of, let's say, if in total cash flows, RV is added. If in total cash flows, residual value is added, then formula will change. like this. Total accounting profit is equal to total cash flows. From these total cash flows, you have to deduct the residual value and minus total accounting depreciation. Is it clear to everyone? If total cash flows are having the impact of residual value also, then you need to exclude the residual value to calculate accounting profit. Is this clear to everyone, this equation? Yes, sir. Actually, residual value does not come into income statement. So if your cash flows are including the impact of residual value, so you have to deduct the residual value. That's what I want to say. Then for calculating total accounting profit from the cash flows, you will not only be deducting accounting depreciation, you will also be deducting the residual value. This thing is happening in our question. If you see the question of Malplash, let me go towards Excel. Total cash flows. Simply uses some formula. Can I say these cash flows are having the effect of residual value? Okay, don't forget that. Total depreciation 220 minus this residual value. So total depreciation will be 130. Now look at this. How we'll calculate the total accounting profit? Cash flows minus the scrap value minus this total depreciation. These are your total accounting profit. If I convert this into average annual accounting profit, the project life is 4 years. So let's divide this by 4. Average investment. Initial investment is 220 plus the residual value, which is 30. Bracket divided by 2. So average investment is 125. Here comes ROC. ROCE. So we are getting 20.4%. Return on capital employed, we are getting 20.4%. I hope this calculation is clear to everyone. Yes or no? Everyone is okay with this calculation? Let's go back to the question. Discuss the suitability of the techniques used in A for determining whether to undertake an investment and advise whether mal-pledged companies' proposed investment is financially acceptable. First of all, you should be able to write 3 to 4 lines on NPV. Number one, which we should be writing for NPV, that NPV is an absolute measure. Absolute measure means which results in a value. The result is a value. And simply, value is not going to mislead the stakeholders. So it's an absolute measure, does not mislead the stakeholders. Another point, positive NPV means the wealth of the shareholder will increase. Another point is NPV actually measures the increase or decrease in the wealth of shareholders. Like in this question, we are having positive NPV, which means that wealth of the shareholder will increase. Now, if I go towards IRR, so first thing you should be writing that IRR of this project is more than cost of capital. Just on this basis, the project is acceptable, but the target of the company is a little bit different. They are focusing on ROC rather than IRR. Okay, and IRR is, by the way, is better than ROC. IRR considers time value of money. It works on cash flows. But after that, you have to write a little bit negative regarding IRR as well. Like if there are non-conventional cash flows, then for the same project, there will be multiple IRRs. In case of mutually exclusive projects, we cannot use IRR. Instead of IRR, we go for NPV. Now let's talk about payback period. I think companies having they are having a target of 2 years, which is not met. But we just need to tell them the payback period is not the superior investment appraisal technique, because returns after the recovery of initial investment are ignored. And plus, payback does not measure the potential impact on the wealth of the shareholders. If we go towards ROC, so you can say that return on capital employed, we calculate ROC on the base by using accounting profit, which can be manipulated easily. Plus, obviously, there's no question of considering time value of money. One thing which goes in the favor of ROC, that while calculating ROC, we consider the entire time horizon of the project. We consider all the accounting profit over the life of the project. But in payback, we just stick to the when initial investment will be recovered. So basically, if we make the decision on the basis of payback, the target is not met because they are having a target of 2 years, and project is giving the payback of 2.3 years. I think ROC target is met. They were asking the plan is the target return is capital employed should be 20%. I think the answer was 20.4%. So on the basis of ROC, if we just talk about this company, their target is met. But it is advisable, they should be making decision on the basis of NPV rather than any other technique. So, dear student, I hope everyone has understood each and everything. Yes, sir. Okay. MCQs and MTQs, there are plenty of MCQs and MTQs in the kit. You should be having a kit, I believe. There are plenty of questions. More than plenty. So try to get the latest kit. It's necessary. Okay, let me tell you what is the agenda for the tomorrow. Inshallah, number one, we'll be discussing the remaining topics of investment appraisal. And after that, inshallah, we will start cost of capital. And the timing for the tomorrow is again same. It will be same, inshallah, 3 p.m. Pakistan time. It will be 3 p.m. Pakistan time. 3 p.m. PST tomorrow. First, inshallah, we'll be discussing the remaining topics. And after that, inshallah, we will start the topic cost of capital. Cost of capital. And I will need little bit more time, especially on Saturday and Sunday. I believe you people can give more time. So I'm expecting that on Saturday, if not, then at least on Sunday, we can start the class a little bit earlier so that we can have a, longer session. So that is, Hamad is having problem. There's a lot of difference. Okay, let's first let us all meet tomorrow, inshallah, the same timing, 3 p.m. PST, Pakistan time, Pakistan Standard Time. Then, inshallah, we'll discuss tomorrow. So, thank you very much that you people have taken out time to attend this class. Thanks a lot and have a nice life. I always say have a nice life, and I don't want to say have a nice day. Why? Because life is itself very short. So that is why it comes from the bottom of my heart that I want all of my students to have a nice life rather than just a nice day. So have a nice life. Thank you very much. Assalamu alaikum to everyone.